This is part 4 of the presentation about how to account for 100% consolidated subs subsequent to the date of acquisition. And in this case, I'm going to show it to you based on the equity method, but then in the end, I'll show you a little of the how to do it if it's the initial value. But if you go to part 5, I show you the actual journal entries. So in this presentation, we're going to walk through those working paper entries. Now remember, when we talk about these entries, unlike the ones in part 3, these are specifically done only on the working papers. So this is a summary of what we did in part 3, and we know that the balance now in the investment account is $623 because we adjusted for the effects of kids' income, dividends, and amortization because we're using the equity method. Now, when we do the consolidated financials, we prepare a working paper. Now, this assumes that we didn't dissolve the subsidiary. Instead, they're going on their own. But now what we have to do is we have to roll them into our financials. And here are just 5 basic entries. Believe me, there are a lot more than this, but we're trying to keep it simple at this point. So we have 5 basic entries on the worksheet, and please do them in this order. If you do them in this order, you've got a really good chance of zeroing out that investment account, which is what you're trying to do. So the first entry you do is you zero out stockholders' equities beginning year equity accounts. Entry 2, you amortize under overvalued assets of the subs based on an adjustment to fair value. The equity in the subs income account is eliminated. B, the subs dividends are eliminated. And we amortize expenses recorded for the fair market value adjustments and other intangible assets associated with the consolidated entry. Now what I'm going to do is I'm going to show you consolidated work papers, and we're going to go through each one of these entries. So here's a little summary of the entries. The first entry we do is going to eliminate these accounts on the subs, which is the 100,000, the 450, and the 500. I'm sorry, and the 50. The next thing we're going to do is adjust to fair market value and record the goodwill for kids' assets. Then we're going to eliminate the equity income. And then we're going to eliminate subs dividends. And when we add all of those up, then we're going to amortize the fair market value adjustment. And then the last thing we're going to do, and then when we add all of those up, they should eliminate the investment of $623. Now, entry S, that's the first entry you do, and this one we're going to, now again, remember, these are going to be done on the working papers, but we're going to show it as a journal entry. So, we're going to zero out subs, little's common stock, paid in capital, and retained earnings, and we're going to credit the line for investment in subsidiary. Now, if purchased other than at the first of the year, remember any pre-acquisition net income of the sub must be rolled up into retained earnings of the sub because we do not get the benefit of any revenue or expenses up to the time of purchase. All we get to consolidate is any revenue or expenses that are accrued after the acquisition. So pay attention to when the purchase is made. All right, so this is what the first entry would look like on the working paper. And if you notice, the credit is going to be in the investment account, and now we have a balance of like $623. And we now, if we go across, the only thing we have for common stock, paid in capital, retained earning are the parents. Okay, the next entry we're going to do is we're going to set up the Goodwill account and other intangible assets adjustments to fair value. In the first year, the fair value adjustments for these entries will be identified during the computation of goodwill. But remember, in subsequent years, we have to adjust for any amounts that we have reduced due to amortization or depreciation. So in our case, we're going to book the current asset adjustment, the land, the building, and the goodwill, and the credit is going to go to investment in subsidiary. And this is what it looks like on the working paper. So now what do we have? We have a credit of $277 in our investment in sub account. Now we're going to do our next entry, and we are going to get rid of the equity and sub income. So we're going to debit our investment account and credit investment in subsidiary. So, we're going to debit and take that income off the books with this debit entry, and we are also going to credit the investment account. So now in that investment in sub account, we have a balance of negative $400,000 based on the entries we've made so far. If we take the 600 plus the 300 plus the 123 and we subtract the 623, we're going to get 400,000. So that's how much more we have to eliminate. And then the next thing we're going to do is eliminate the sub's dividends, and we're going to assign the difference to investment in sub. And lo and behold, there's our 400,000. We're going to debit investment in sub and eliminate the sub's dividends. So again, now if we take and subtract that from our credit of 400,000, that will zero out that investment account, and we have still one more thing to do before we can add across. So again, if we add all those up, we get a negative 623, our credit 623, and we have a debit balance in the investment account, so that means it's going to be zero when it goes across. Now the last entry we have to make is the amortization, and again, we never amortize land or goodwill. So that's going to go to expense. Normally we'd break it down. In this case, it would be amortization and depreciation, but we're just going to show it as expense. And so this has no effect on that investment account. Instead, we're going to book the expense, and then we're going to adjust the balances for our assets and our building. And so there is our entry. And now we can add across. And now we have our consolidated totals. So you notice with this that the investment account has been zeroed out. The net income of the sub equity of 123 has been zeroed out. The dividends and the equity accounts of the sub have been zeroed out. And now we have our consolidated returns, and this is what would appear on the parent's books. So here are the entries based on, instead of 1, 2, 3, this is our S entry, and this is our A entry, and this is our I entry, getting rid of that income, and here's our dividend, getting rid of those dividends. And the last we have is expensing the amortization or depreciation. And so that shows you what it looks like, the entries on the working papers or the journal entries if we were doing the equity method. But what happens if we'd been using the initial value method? Well, if the parent uses the initial value method to account for the investment, then the consolidated entries will change only slightly. Because there have been no adjustments or are recorded in the investment account for the current year operations, dividends paid by the subsidiary or the amortization of the purchase price allocations, and dividends received from subsidiary were recorded as dividend income. What we're going to have to do is we're going to have to make a couple additional entries and not do some of the entries we just discussed. All right, so when the initial value method is used, the 5 basic entries to the worksheets change by not using entry I after the first year, using entry C. Also, entry D changes because dividends are recorded as revenue for the parent under the initial value method. So, the S, the subs equity accounts are eliminated. We still do A the same, but now we have entry C. For subsequent consolidations, you must adjust beginning retained earnings of the parent for the prior year's sub income less amortization. And we need to B changes to eliminate subs dividends from income of the parent. And amortization is recorded for the fair market value adjustments. And so that one is the same. So let's see what it looks like on the working papers. Again, there's S. There's A. And then we have B. In this case, it's taking off dividend revenue. And then we do. Now, for additional examples, including the partial equity method, please go to Part 5 of this presentation because I walk you through each one separately. And that ends this presentation for Part 4 for Advanced Accounting.